Gold has resumed its rally overnight, mainly on the increasing expectations that the US Federal Reserve will pump more money into the American economy. Last week, gold lost just over 3%, but since late July, the precious metal has rallied 20% to a record $1,387 an ounce. That was on October the 14th. To discuss the prospect of further price gains, I'm joined by Jonathan Barratt, Managing Director of Commodity Broking Services. Jonathan Barratt, welcome to Business Today.
Good morning, Simon.
And as we just saw in that last story, the gold price is encouraging all sorts of smaller ventures, but is the price also spurring larger miners back into operation?
Yeah, Simon, I think that's the interesting thing, because when you see that you've got certain gold in the ground at particular levels, it becomes uneconomical to mine. And when you think that it costs about $300 on average an ounce to actually mine gold, then as the price goes up, it certainly encourages more of those tallings, or that gold which has been hard to get. It now becomes more profitable to do so. So yes, it is encouraging more miners actually to get to that gold, just purely because the economics make it stack up.
And some analysts are saying the price will resume testing new highs due to slowing production and an appetite among central banks to hold more gold. What's your view?
Look, I think it is interesting, because when you look at general supply-demand scenario for gold, we normally run at about a 400 to 500 tonne surplus. So far this year, we're actually looking for the same in terms of the surplus, but certainly gold's picked up in terms of its attractiveness to central banks. And I think that's where it's important, because although central banks don't go into the market to actually go and buy it, they look to accumulate it in other ways. So it is important, and it just adds to that field for gold that it looks well bid on any dip.
And when do you think it'll test the record again?
Now, that's going to be the tough one, Simon, because I think when I look at where we're going with what's happening, gold is certainly running on the back of a weaker dollar rather than on supply-demand scenarios. So, if anything, I think towards the beginning of the new year, I think the market might look to challenge it. But up until then, I think we're still sort of trading a little bit of a range.
Okay. After the weekend G20 finance ministers meeting, all metals generally rose. Why was that?
But this is interesting, because that's something which it's a hot topic at the moment. A lot of the metals moved higher purely on the back of the US dollar weakening, not on the back of specific demand. And I think that's generally a concern that we're actually holding. We're trying to work out, is it a real supply-demand scenario that's actually causing the price of metals to move higher, or is it just the weaker US dollar? And I think this is something we've got to try and work out, because it's very hard to push these higher prices through economies which are still just trying to struggle.
Okay, the softer US dollar is also pushing oil prices higher. Do you think that trend will continue?
Well, this is an interesting thing too, because when you look at oil, we've got record inventories. So you're seeing that the weaker US dollar is pushing the cost of oil a lot higher. I actually feel that oil in itself, because the market fundamentally knows there's quite a large surplus in terms of inventories there, will actually stagnate in a bit of a range. And I think that range we've seen is pretty much 84 on the top through to about 80 and 79.40 on the downside. So oil, I think the US dollar is trying to make it trade higher when it weakens, but at the end of the day, people are pretty sure of what the fundamental picture is, and that's probably sort of putting a cap on it.
So do you think oil prices could go lower in the short term?
I hope so. When you look at the analysis we've got, I actually feel it's a lot easier for economies to move to get into more of a profitable situation if the primary cost of inputs are a lot lower. So you can see economies moving a lot quicker and clear a lot more profitable if the price of these primary inputs are lower. So I'm of the advocate that actually thinks that oil can actually go lower rather than higher.
Okay, let's take a look at copper now. It pushed above 27-month highs on the back of a two-year high. What's driving prices there?
See, copper in itself is quite interesting, because we do have an actual deficit in supply and demand. So that when you actually look at the metal, we've seen inventories continuing to draw. And it is quite an interesting look into a metal that has a structural deficit in terms of its supply. And when you do get that bout of increase in economic activity, then you see the price actually should move higher. So we've actually got copper moving higher on draws in inventory, draws in demand, and also a weakening dollar. So that's a space which we're focused on, particularly for Q1 next year, because prices can actually move a lot higher for copper.
Okay, now that unexpected rise in China's interest rates has caused some concern in China's steel industry. What are the reasons behind that?
Look, I think basically the increase in interest rates by that 0.25%, and a little bit of a surprise, the market's thinking, well, gee, things have to slow down, or China is looking to slow down the growth in their economy. And as a result of that, the concerns that they've got in terms of production, they want everyone to actually hold back as well. When you look at the steel industry, when they see that increase, they're actually saying that, okay, the economy's moving too fast for what we like at the moment. We want everything to slow down, and as a result of that, production for steel should also slow as well.
Okay, Jonathan Barratt, thanks very much for your time.
Thanks, Simon.